All right, everybody. We're going to be here with Mark Putrino, former hedge fund manager. We're going to be going over a couple of things in the markets, but um, I need to get him set up here. 1 second, folks. And basically, Mark is going to have about three setups, um, three trade ideas, and we're going to do a covering of the markets as well in a minute here or two. I'm just trying to get him set up here on the Zoom in a minute. Okay, folks. So thanks a lot for the patience here. And I believe that now we do have Mark Petrino here in the house. So we definitely want to make sure that we give Mark a warm welcome here. Mark Putrino, former hedge fund manager and also chief educator at the Benzinga Trading School. What's going on, man?
Hello, Rodrigo. How are you?
How was the class today?
That was good. It was real good. Um, yeah, it was good. You guys, it seems like we're getting some new faces, and we got some good trading ideas. And yeah, the class was really good.
Right, and I know that you definitely cover. I mean, you've been covering the markets for about 20 years. Give me one quick second here, Mark, so that we do have the Twitter space for everybody there to know. But um, okay, basically, Mark, I know your background. I know you've traded with Stevie and Gabelli, but for those that maybe are just, for the first time, maybe here watching this, if you can give us a brief rundown, of your experience on Wall Street.
Yeah, well, I was in business school, and I met Mario Gabelli, who is a legendary money manager, is well known. Some of the people listening now probably know. So anyway, I was lucky enough that he gave me an opportunity to work on his trading desk, and I was there for a few years, and then I made a move over to work for Steve Cohen, who is one of the greatest traders ever. Now I think he basically spends most of his time with the Mets. He bought the New York Mets, the baseball team, and supposedly the show Billions is about him. I've never seen it, so I don't know. But when people find out I work there, that's a question I get: is Billions realistic? Probably isn't, but um, uh, so then out from there, I spent 3 different 5-year stints at 3 different big institutional money managers where I was the head of trading. So I've overseen trading of pretty much every style that you could kind of think of, everything from high frequency to deep value, bonds, currencies, options. I was a market maker for 2 years. So I've been around the block a few times. There's not too much I haven't seen. And a lot of the stuff that's going on now is really very similar to what was going on after the NASDAQ bubble or after the housing bubble. So history doesn't repeat exactly, but as Mark Twain says, it rhymes. And we're seeing a lot of similarities. Like, for example, I guess probably the most obvious was back in 1999 and 2000, you had this huge rise of the day trading community, right? Where people were leaving their jobs to go become day traders because day trading was easy. Well, it sounds kind of familiar, doesn't it? Sounds kind of like what was going on in Reddit a year and a half ago. And sure enough, when all that stuff happened, that was a sign that we were getting to the top. So in the trading class, we went bearish around November or December. for reasons that are pretty simple to see. The market was really starting to fall apart back then, but the money was flowing into the big names like Apple and Microsoft, and that was pushing the broader benchmarks higher, but that masked that underneath it, there was actually a lot of negative stuff going on. So yeah, so anyway, so the class is good. I have a good background for it. We just want people that want to learn it. It doesn't matter your experience level. It's not a trading mill where you come and get your idea of the day. We come up with multiple ideas every day as we go through the markets, and different people have different takeaways. Different people act upon different trading things. So the classes cover, there's 8 classes and they recycle at the end. So it's not like we just have 8 classes and then it's over. And the classes cover important market principles. One is that there are some price levels that are more important than others. These are support levels, resistance levels. Class number 2, or the second principle, is trends. Markets are always trending. How do you identify a trend change? 3, momentum. What is the momentum driving the trends? Then we have a class on psychology. They have a class on patterns, like, the head and shoulders pattern, the ascending triangle, and so forth. And we have a class, today's class was actually how to build trading models and come up with trading models and strategies. And then we have a class on how to go through the markets from a macro point of view to look for trading ideas. So every day we come across different stuff that we say, hey, look at that. That looks like it could be an idea there. We let the market tell us what to do, right? We don't go in there with a preconceived notion.
Right. And what would be, let's just say for new traders, some things they could use, Mark? Just a couple of key insights maybe from the school that maybe they could use to kind of get by, or just maybe tips right now during bear markets, because most people maybe have not been during one, like you've mentioned, right?
Yeah. All right, I'm going to take the screen from you, right?
Yeah.
If that's okay. All right, guys. So I'm going to show you my screen.
Yeah, and just remember, Mark, that we do have some people on Twitter as well. So, I mean, if they can't see the charts, maybe the numbers or levels would be important.
All right. Well, one of the things that we did today is if you look at this chart here, and you can get a lot of these charts on BZ Pro, but if you go up to these indicators and you look at all these technical indicators, and the people that aren't watching but are just listening, they've probably heard of a lot of these things like Bollinger Bands or the relative strength index or whatever. So there's probably, I don't know, 100 different indicators in here. So we go through these. One of the things we do is we go through them all and try to figure out how to actually use them and how to apply them. Some of these indicators are probably kind of really not worth looking at, kind of a waste of time. Some of them are actually really good, and we've come across some really good ones, and some of the students have come across some really good ones too. Like, for example, I know a bunch of you people can't see this, but just bear with me. Like this particular indicator here, I had never even heard of. Well, I'd heard of it, but I had never even seen it until one of our students said that they've been using it. And I'm just going to make a little default change here. But basically, if you get a red arrow, it's a sell signal. And if you get a green arrow, it's a buy signal. All right. And as you can see, it's been very accurate. This up here just happens to be the utilities ETF, where we got this buy signal here. But anyway, the point is that part of the class is we learn how to use and apply all these indicators. And like I said, this wasn't even my thing. One of the students pointed this out, that they use it. So there's a lot of interaction. There's a good community, and we come up with ideas pretty much every day. And like today, we're spending a lot of time with this indicator, and I think a lot of people now are going to make this kind of part of their repertoire, right? So I know a lot of people can't see it, but for those of you who can, basically, if it's pretty simple. If you get a green arrow, it says buy, and if you get a red arrow, it says sell. So if we look here, buy here, sell there, buy here, sell up there, buy, sell, buy, sell. Then if you get 2 buy signals in a row, you'd probably just not do anything. But then you got your sell up here, buy, sell, you want to do anything there because that's a sell, but buy, sell, buy, sell. I mean, this thing is like really accurate. So yeah, so a typical class is we spend the first part of the class talking about the principles. Today's class was investment strategies and trading systems. And then we look into the market in real time to see if we can apply any of the stuff that we covered in the class to the markets in real time. Because the fundamentals of markets are not going to change, right? There's always going to be price levels that are more important than others. There's always going to be trends. There's always going to be trend changes. But what changes is the market. Things act differently at different times. Like the market is, since the class started, we've seen a top. Now we're in a crash or in a bear market. I mean, parts of the market have definitely crashed. So we go through that, and then we just go through the market. We see what's in the news, see if we can find any ideas. We really focus on important levels. Like, for example, for those of you who are looking at this is what we call a support level down here, right? When markets are going lower, there's not enough demand to take in all the supply, so the seller's got to push the prices lower. When we get down to a support level, the dynamic changes. All of a sudden, there is enough buyers or enough demand to absorb all of the selling or all of the supply. So it stops going down. Now, when we get up here, you can see this was back in February. We have the sell-off. Well, where did we come to a bottom? Right here. It's not a coincidence that we came to a bottom here. It's because it was a support level before. So in the institutional trading world, in the hedge fund world that I was in for 20 years, I can tell you with 100% confidence that no one looks at bizarro things like harmonic charts and Gann theory. As traders, what we worry about, or what we focus on, is what price levels are important, what are the trends, what's the momentum driving them, and then what's the psychology. And that's pretty much it. We keep it simple. The simple principle is when a stock or a market is oversold and it gets to support, there tends to be a bounce. And that's what happened here, right? So this was, I don't want to say it was an obvious trade, but it was about as obvious as they get, that we found we were oversold and we found support, broke the downtrend, and then we made this move higher here. So this is the utilities ETF. This is the utilities sector. So the next step would be to go within
really
the
quick,
sector.
Mark, here for those that don't know, what is the utilities sector for those people that maybe might be new here?
Oh, I'm sorry. The symbol is XLU. This is the utility sector spider. So the S&P has 11 sectors, and every day we look at the sectors just to see kind of what's going on. So this is a benchmark of this part of the market. So if you know what's going on in the 11 sectors, it gives you a much greater feel as to what's going to happen in the broader market. So when we saw this get down here and was oversold and got to support, then the next step would be to go look within the sector for the stocks that look like they're going to move the most. I mean, if we're right and the utility sector is about to bounce, well, there's going to be stocks that bounce maybe 2%, and there's going to be stocks that maybe bounce 10%. The idea is to kind of go through them, and it's not as hard as you think. We just look within the sector ETF, the XLU, and we just look at the fact sheet and we see what are the big holdings, and then we go through those names and see if we could find something that looks like it's going to move the most. That's a part of trading, is understanding how to deploy your capital. What's the best use of your capital? What's like the best bang for your buck? And if you're right on the direction of something, it will come to your style, whether you're buying the stock or whether they're buying the options. But if a sector is moving one way, there's going to be stocks that are moving more, and there's going to be stocks that are moving less, because the sector is really just the average. The XLU is just the average of all the utility stocks. So that's kind of what we do. I guess you could call it kind of brainstorming a lot, or improvisation, just kind of see where it goes. But yeah, we tend to come up with trading ideas every day. And, the class is mostly technical analysis. But
Right. And
we cover other stuff too.
what can you tell the folks here about why, and I think you actually cover this in your school, the psychology part, the investment psychology, but why do you think that's important, not just for new traders, but also for traders that maybe have been around as well? For,
Well,
trading.
because people lose money because they make emotional mistakes. When people, humans, everyone, me, you, everyone, for some reason, when it comes to money, people act irrationally. They just don't think clearly or rationally sometimes. Like I'll bet you a lot of people who are listening to me right now have know someone like this, who, a person who, like, if they're going to buy a dishwasher or a refrigerator, will spend, a couple of weeks looking for the best price, waiting for it to go on sale so they could save a couple $100. But that same person could get into a chat room and, a bunch of people say, oh, we're all buying XYZ. And that person could throw $5,000 or something at XYZ without even thinking twice about it. So money makes us do irrational things. Now let's bring that to another step. Well, actually, let's stay on that for a bit. The biggest mistakes that traders make, and I'm talking about like short-term traders, day traders, proprietary traders, the biggest mistake that they make is they hold on to their losers for too long and they sell their winners too soon. And meaning that you sell something well before it gets to your price target. Now, the reason why people do this is because of fear. They're afraid of losing a profit. So this is where the emotional thing comes into play. If someone has a paper trading system or just a style that or a strategy they're working out on paper, but they don't have any real money in, it's pretty easy to come up with good trades, right? You've signed something that's overbought or oversold that looks like it's breaking its trend. That's relatively easy to do. All right. But if you have real money on the line, it's not. That makes it a whole different ball game. So if you have your system tells you to buy 1,000 shares at 20 on paper, and your target is 30 on paper, and you buy it at 20 on paper, and you just start watching it to go higher, and it gets to 24 or 26, then maybe it goes back to 25 and goes to 27, then back to 26, and then it finally gets to 30, and you say, oh, gee, this is great. I'm gonna sell it. On paper, I got a nice return here. I made 50%. Right now, think about it in another way. If you bought 1,000 shares at 20, well, now it goes to 20. Now say it goes to 22. Well, on paper, it was like, hey, whatever, man, I'm just going to watch it go higher. But in real life, it's like, wait a second, I got $2,000 of profit here. I don't want to lose it. I don't want to let it get away. Maybe I'm going to hold off for a little bit longer. Then it gets up to say 25, and it's like, wait a second, I got a $5,000 profit here. It's not close to my price target, but I don't care. I'm going to take my money. Wham, you sell it. And then guess what? And 2 weeks later, it's at 30, and you say, I should have waited. So emotions prevent people from sticking to their strategies. On the other side of it is, if you're a trader and you have a loss, you should get out of it right away. You just try to minimize it. But someone will buy a stock and then it'll go against them. And then all of a sudden it's like, oh, I'm going to hold on to this. I hope it comes back. And we could actually see that on charts, believe it or not. It's buyer's remorse. And I bet a lot of people.
Right. And we have a question here from John Moore from the YouTube side asking, and I've seen John around. He's asking, how do you feel about trailing stop losses?
Oh, I think they're great. I think a trailing stop is where you say you buy something and it goes higher and it keeps going higher and higher and higher. And you say to yourself, well, how do I lock in my profit here? I got a nice profit, but I want to lock it in somehow. So you might say, and I'm just pulling numbers out of the air, it would be different for different stocks depending on their volatilities. But you might say, all right, well, if my stock goes down by 3%, I'm just going to sell it. I'm not going to get the absolute top price, but I'm going to lock in my profit. Let's just say, just to make the math easy, right? All right, you buy something at 50 and it goes to 100, and you tell yourself, man, if this thing goes down by 3%, I'm going to sell it. So if it rolls over and it gets to 97, you sell it. It's not the same as selling it at 100, but if it gets to 97, there's a chance that the trend is over and a new downtrend is forming and it goes lower. And just to, expand on that, if it goes to 200, what's 6% or what's 3% of 200 is 6%. So in that case, you would say, all right, well, if it gets down to 194, I'm going to turn around and sell it. So I think every trade you should have a trailing stop out on it. And you should use logic when you do it. In other words, you don't want to have a trailing stop that's too tight if you have a volatile stock, because you'll get stopped out of it too soon. You also should be aware of like important support and resistance levels. Like if you don't want to have, if there's an important support or resistance level, that's going to affect where you would have your stop out. Like for example, if I had a stock and I had a trailing stop and we just got through important support and the 3% trailing stop was below the important support, I would probably say, well, if this thing is, if this thing breaks this support, it's probably going to go lower. So in like a situation like that, I would move up the trailing stop to where the support was. So I guess, not to confuse people, but use trailing stops, but have a rational, logical way to use them. Don't just say, okay, I'm going to have a 3% trailing stop on this. I'm going to have a 3% trailing stop on that and a 3% trailing stop on this, because of maybe that works for a utility stock,
right.
But maybe for a biotech stock, you need a wider range there.
So since John asked that question, I guess we can kind of discuss a little bit, really what your view is, Mark, since as the chief educator of the trading school, right? What is your view on risk management and really how the school kind of can fit in? Because I do know it's a big struggle point for many traders.
Well, risk management is, risk management. Well, here's the thing, man. Everyone, or not everyone, a lot of people that aren't on Wall Street or retail traders, they think that these great traders have these great secret super systems that always work. And that's wrong. They don't. All right. The best traders lose money on a lot of trades. The best traders out there probably have a 50 or 60% win rate. If you see all this stuff like, oh, I've got a 90% win rate or whatever, it's, I don't know. I would be skeptical, because here's the thing, right? The guys or the people that are really successful are the ones who understand how important risk management and investment psychology is. So you could have the greatest system in the world, but if you don't have the emotional discipline to stick to it, which is intelligence, or investment psychology, if you don't have the discipline to stick with it, it's not going to work. So the people that are successful are the ones who understand that. Now, in terms of risk management, it's like you don't want to put too much of your capital into any one idea. Like you got to say to yourself, how much of my money am I going to put into one idea? Is it going to be 5%? Is it going to be 10%? Is it going to be 20%? Is it going to be all? That really comes down to kind of a personal decision. But with risk management, what I would suggest is this: figure out what your maximum loss is. Like, what's the maximum loss that you're comfortable with taking, right? And say you got a $20,000 account and you say, all right, the most I'm comfortable with taking is a 2.5%. So that's $500, right? So if I can do all my trades, but never have a trade that I lose more than $500 on, you're going to end up being way ahead, because if you lose the $500, you're just going to get out of it. But if your trade goes the other way and starts making money, you're going to let them run, right? So you would, in that case, you decide the most they'll possibly lose is $500, and then you would take your position and say, all right, if it moves X percent, that would be a $500 loss. That's where I'm going to get stopped out. So we're not really looking at how much we can make. We're looking at how much we can lose. And if you manage your losses, the winners take care of themselves. So when you trade, you're going to have 5 possible outcomes. You're going to break even, you're going to have a small loss or a small gain. Those will all cross each other off. Then you're going to have a big loss or a big gain. If you can prevent from having the big losses, the big gains will take care of themselves. So that's really what is the difference, I think, between someone who's successful and someone who's not successful, is that the people that are successful only have small losses. They don't let their losses get out of control. The people that aren't successful, they put too many eggs in one basket, or they hold on to stuff for too long, watch it go lower. So risk management and investment psychology are really if there is a holy grail to trading, in other words, like the holy grail, the thing that's the ultimate secret. If there is a holy grail, then that's what it is the risk management and psychology. So we spend a lot of time talking about that. And people will say, well, what's the best trading system? Should I use a moving average crossover thing? Should I use DeMark signals? The answer is there is none. It's what fits your personality the best. Some people, what appeals to one person might not appeal to another person. Everyone has to use their own trading system or something that fits your personality. That's why I don't like this whole concept of like watching me trade live. Like a couple people said that I should do that. Like, oh, Mark, we should watch you trade. But it's like, why? You're going to trade completely differently than how I do. So the trading school, we teach you how to think for yourself. It's the school. That's my goal, at least, to teach people how to think for themselves. And the people that get it, they've really, it seems like some people, it's really made a big difference to them. And a big part of it too is that a lot of people don't realize that you can make money when the market is going lower. You can buy inverse ETFs. You can buy options that are called puts, which go higher if things go lower. But in a lot of ways, it's easier to make money in a down market because down markets go faster than markets go up, because down markets happen because of fear. And fear is a stronger emotion than hope is. Markets go up because of hope, but they go down because of fear, right? So that's part of our psychology. And going back to our investment psychology, I'm just going to pick a random stock. I don't know. I'll pick Apple. Well, actually, there was news on Apple, so I'm not going to pick Apple. I'm going to just pick Alcoa, for example. Down 3%. All right, well, let me go to another one because that could be because of steel prices. So let me take that back. I'm just going to bring up Intel. All right, so Intel is up 1.3% today. Okay, Intel has a market cap of $1.5 billion. It's up 1.3% today. So that's what, like roughly, $2 billion or whatever. What has happened to this company that has made the valuation of it go up by 1.3%? The answer is nothing other than investor perceptions. So that's psychology. The market moves because of psychology. And going back to this whole concept of people buy things and then it goes lower and they hold on to it and wait until it comes back to their buying price where they can sell and get out of it. Look at this chart here for those of you who can and those of you who can't. Looking at the XLK, the technology spider. You can see back here in November and December, this 163 level was support. But then look what happens. It converts into resistance. Support here becomes resistance here. This chart is an illustration of mass psychology, right? It's not tea leaves. It's not astrology. It's psychology and supply and demand. People bought back here, and assuming they still held it, once it broke below the support level at the end of January, a lot of the people now come to regret buying it. They say, oh, I'm losing money. I'm going to sell it to get out, but I'm not going to get out. I'm not going to get out with a loss. I'm going to wait for it to come back to my buy price, and I'm going to sell it at the same price I bought it at. So look at this. Support becomes resistance. There's enough disgruntled or remorseful buyers placing sell orders at their buy price that the level that was support becomes resistance, right? So this is psychology. So again, in the institutional trading world, this is the type of stuff we look at. What's the important support level, resistance levels? What's the momentum? no one's looking at these esoteric far out things like, Elliott waves and whatever else, harmonic charts. So just by simple common sense, the students are learning how the markets really work, how Wall Street really works, what really goes on in all these hedge funds and everything, and how to come up with trading strategies that fit their personalities. So far, I would say so good. It's been a great success. We're getting a lot of.
Mark, so this is pretty much like tailored for each person, right? Because I know there are some people that maybe want to trade more actively, and some people that maybe want to be a little bit more longer term, right?
Yeah, everyone has a different style. Everyone's a little different. I like this analogy. It's like, you don't go to a karate school to hire the sensei to go out and kick someone's ass for you. You hire the sensei to teach you how to defend yourself if you ever need to. But everyone's going to be a little bit different. So everyone's got to do what fits their style. Some people are very energetic and they want to be in and out of the market all day, and they could be day traders. Other people are more, maybe they're more chill and they don't want to have to pay attention to the market all day, or maybe just for practical reasons they can't, because of their job or their family or whatever. They might have a longer term strategy. There's students that ask about how to read income statements and financial statements for more of the fundamental type stuff. So everyone's a little different, man. I mean, I know some of them get in on ideas together, but everyone has a different style. We have people that just trade biotech. We have people that just trade Qs. We have people that trade everything. We have people that are just option traders. We have people that only trade options, that only buy puts. They only want stuff that's going down. But a lot of the people have been surprised very happily that, well, the ones that joined in the fall that didn't realize that you can make money when the market was going down. Some of the people have told me that they've had their best days ever over the past few weeks, because it was pretty obvious that some of the selling was coming when some of these clear support levels broke. And I think some of the people, I think you might have even done this, Rodrigo, like bought options on one of the inverse ETFs, the Qs. So in other words, if the stock market goes down, this particular ETF that's leveraged and inverse will go up 3 times as much. So if the stock market goes down by, say, 5%, these things will go up by, say, 15%. And then you take that to the next level, and there's people buying options on that. So I don't know for sure, but I would imagine some people, doubled or tripled or even more of whatever it was they invested on one day. So that's a good feeling when I hear people talk about that. A lot of people just don't understand. And when I watch the media or whatever, and I see people saying like, go to cash, go to cash, go to cash, I just don't understand that, because if you think the market's going to go down, why would you go to cash when you could buy an ETF that's going to go up, right? Like, for example, there's this one ETF here, and these are just a couple of the things that we talk about, how to protect your portfolio, hedge your portfolio, or even profit in a down market. This particular ETF here is inverse to the S&P 500. So if the S&P 500 goes up or goes down 1%, this will go up 1%. So this is good for obviously trading, making money, but it also, maybe if you have a big portfolio of stocks and if you were to sell, you would take a lot of gains, which might hurt your tax situation. You don't want to sell, but you think the market's going to go lower. Well, then you can add something like this, SH, to your portfolio as a hedge. So if your stocks are going down, this will be going up. And right, in a perfect hedge, it would be completely flat.
Right. And a couple of people here have some questions on the Zoom and the YouTube side. So we're just going to get these out of the way, and then we can carry on here, Mark. So are the sessions for the trading school recorded? Yes, all the classes, all of them, they're recorded, and they pretty much go to the video library for the trading school. So everything is going to be there, even if you cannot attend live. There's live trading rooms as well. Those are open 24/7 with Mark, basically with Mark Putrino's setups and the students as well. So it's pretty much, like a community sense, if you will. And more importantly, also remember you get Benzinga Pro, which is our market research terminal. So good question there, Phil. So it is there's a 7-day trial for $7. And after that, if you want to keep it, it's $14.97 for the year. It renews at the same price. Good question, Joanna. And yes, everybody that joins gets a free laptop. So that kind of covers most of the stuff, most of the questions. Let's see one more. The classes are 7 to 9 a.m. Eastern, and then 12 to 1, 12 to 1, right? And then on Friday, you meet only from 7 to 9. So that's all the schedule. That covers the questions here, Mark. But besides, I mean, unless you do want to add anything, I know you added like a newsletter there, or some sort of something like that.
Yeah, we have a weekly newsletter that I do. So this was this week's. So it's a class. So I like to teach, and it's about history. So I just wanted to point this out here because it shows that things, they don't repeat the same, but I guess you could say they rhyme, right? And I will just kind of briefly go through this here. So I have this train here, as you will notice. This is a big train, which is quite large. I like trains. But anyway, I put that there because I wanted to talk about the Great Depression of the 1890s. Now, most people know the Great Depression of the 1930s. Some people, or economists or historians, say that this depression was even worse. So what happened that caused it? Well, the Panic of 1893, which was a big panic in the stock market. What led to the panic? Well, the bubble in railroad stocks, right? Sounds familiar? They were making trains that went to nowhere. So, railroads were the hot stocks, and they went into a bubble. 60, 70 years before this, it was the canal stocks that went into a bubble. Then in the 1990s, it was the internet stocks that were in the bubble. A couple of years ago, we saw all the cannabis companies were in a bubble. All right. So history repeats itself. So this led to a really bad depression. And the reason why is because of monetary policy, like we talk about now. When they talk about quantitative easing or the Fed's balance sheet and all that kind of stuff, we're talking about monetary policy. So President Cleveland's, Grover Cleveland was the president, and you'll probably be hearing a lot about him if President Trump runs again, because Cleveland was the only president that was president twice, but it wasn't in a row. So he was president, and then I think Benjamin Harrison became president, and then Grover Cleveland won it back. But anyway, he had this really hardcore devotion to the gold standard. And it was almost like it was an ethical or moral thing back then. A big part of what went on in politics in the late 1800s was this debate over hard money versus soft money. So here's the thing. When you have hard money, meaning you don't print money, you don't have quantitative easing, if you're on the gold standard, every dollar out there has to be backed by gold in a vault somewhere. So the people of the the Northeast, like the mercantile people in Boston and New York, they wanted to have a gold standard, but all the farmers out West, they wanted to get off the gold standard. Because here's why. When you have an economy that's expanding, but you're not expanding the money supply, it causes deflation. So cotton went down by 50% in just 5 years. So all the farmers that were growing all this stuff were really getting hurt. So anyway, monetary policy was was influential back then. So when you hear all this stuff about quantitative easing, it's not new. Matter of fact, after the Civil War, the price of gold started going down, and the government paid off its bonds in gold. So what do they do when the bond prices started going down? Well, they went into the market and bought bonds to prop them up, just like they do now. So we just talk about what we're going to look at in the market this coming up week here. So this is from Monday. Oh yeah, we can see there's our utilities, oil, wheat's breaking down, copper. We have a trading lesson, and then we do a little bit more education. And then I come into some of these people here because I have a pretty cynical sense of humor. But these were the robber barons. I mean, these weren't all of them. There was a bunch of them. which were people that were basically, I guess, what you would call them as an actual oligarch. I mean, the oligarch definition of an oligarch is someone who's powerful enough to influence politics, right? Well, we know that Michael Bloomberg and Bill Gates with, or, I'm sorry, Mark Zuckerberg with his Zuck bucks, and Michael Bloomberg, and Bill Gates, these guys use their money to influence the election. So these are robber barons, but it just shows history repeats. This guy is Jay Gould. He was a famous market operator, or what you would probably call a hedge fund manager back then. He tried to take over the Erie Railroad. He tried to corner the gold market. So pretty interesting guy to read about. This is JP Morgan. And see here, I have, by the way, did you notice my hat? You may think it's ridiculous, but in my day, you probably would have thought it looked great. So we talk about this in our investment psychology class, the herd mentality, right? Why do you think fashion is good looking? Or why do you think your shirt is good looking? Or why do you think a tie is fashionable? Well, it's because society tells you it is. So the point is that a lot of times what you think are your thoughts are your own, are not. You're
Right.
being influenced by external stimuli. And this is important in the trading world because we want to understand what is happening, helping us or making us think we should make this decision. Going back to the thing where I said, right, like, oh, well, if you go into a chat room and a bunch of people are all, saying, oh, we just bought the stock, blah, 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 blah. It's like that herd mentality, that herd mentality could get you sucked into it. So the same thing that makes people think fashion is fashionable could hurt you in the market.
Right.
So here's Grover Cleveland and the gold standard. So yeah, so I like to do a little historical thing because, I think it helps us by understanding the history of the markets. It helps us understand what's going on now.
It's very good to have that sort of like, I guess, roundup, if you will, right? You do talk about stocks there. So, Mark, what about the whole deal with inflation right now and rates? Where do you see that going? And, with oil as well, where do you see oil in between all that?
Well, it looks to me like all these commodities are starting to come on in, which is probably due to economic slowdown type stuff. If you look at like wheat, if you look at copper prices, I started writing about copper. I started writing about inflation in August of 20. All right, so let's go back to there. So these are copper prices here. So I started writing about inflation back here. Now I don't know why no one else, they don't. I guess they don't have charts over there at the Fed, but the price of copper soared from like 216 up to 290 in a matter of months. So that told me that we were in an inflationary environment. So I've been inflationary, since then. But look what's happened over the last couple of weeks. Copper has completely collapsed, right? Totally fallen apart here. We could look at our wheat prices. Wheat is completely fallen apart, right? Support breaks, a shorter term version of that. Look at that. So this tells me that we're going into a slowdown. It's already here. So this will probably reduce some of the inflationary pressure. And I would suspect it already has. So I think now, now it's like, well, maybe inflation's cooling off, but is it cooling off because we're going into a recession? So that's kind of the magic question now, which we're going to find out over the next few weeks or a few months or so. So yeah, so inflation's slowing down, but it could be slowing down for a bad reason. So that's kind of where our take is on that there.
And for those that are asking about this stuff, so basically we don't have like a class on like all the small little details and things like that, but you do cover pretty much things like that, even the little details with Mark, like CPI, PCE numbers, what's happening, with the Fed talk and all that stuff. It's just important really to number one, understand what's going on and how to position yourself and your portfolio as a trader, right, Mark, around that, learning those things. And also some people can't learn it because they really have not lived through certain periods of this volatility, right?
Yeah. Well, the market's always kind of changing a little bit. It's like I said, the principles remain the same, like the fact that price levels are more important than others. But but the market changes. People think the stock market is like a chess game, and the chess game, they think that you know the market's like chess, and if I think about it enough, and if I could think far enough ahead, I could really come up with a way to win, or really figure this out. But that's not the way the market works. Think about this: not all of them, but a lot of these AI driven hedge funds that were so popular 5 years ago have had really bad returns. Why is that? Well, because they go into it thinking the market's a chess game. If we get all these like mathematical, super genius geeks or whatever from NASA, they're going to be able to figure it out. Well, guess what? They can't, because they don't know that the market is driven by irrational emotions and investment psychology. They kind of miss that whole big part of it. They base AI on probability and statistics, and that assumes that people are rational, and people are not rational. So the market, to me, should be viewed more as like a poker game, right? Now, poker requires skills and there are rules, but the game changes day to day. You could be playing poker today against someone, and they're on the other side of the table there. So you're trying to read their emotions, see if they're, giving any clues or whatever. But say you play that same person today, and then or the same person you play today, say you play in a week from now. Well, there's going to be a different emotional mindset, right? Who knows what's happened between now and then? Maybe they didn't get a good night's sleep. Maybe they got into a fight with their spouse. Who knows? Maybe you didn't get a good night's sleep, or you got into a fight with your spouse. So, what works today might not work in a week, because just people are just thinking differently. So, it's an important. So a lot of our students are, I would say are intelligent people, which is why they're drawn to something like trying to learn about the market. So a lot of them come into it with this idea that, like, all right, I can really figure this out, like with the mathematical details and all that. And it's just not, if you do that, you're going to drive yourself crazy, because it's not going to work. You have to understand that if you buy a stock or sell a stock, there's someone out there in the world that has an opposite opinion of you. If you're buying it, you're buying it from someone who wants to sell it. If you're selling it, you're selling it to someone who wants to buy it. But we have emotions. This is why we have bubbles. Like, this is why if people weren't irrational and emotional, we would have never had a Reddit bubble, right? Most of those stocks didn't deserve to go to where the levels, to the levels they did. They didn't make any money. A company that doesn't make any money shouldn't be trading at $300 a share. So understanding that this is a game of, I don't want to say a game, because that kind of diminishes it, but understanding that what we're looking at when we look at a chart is emotions and human psychology. And we saw it over here with this XLK chart about how a level that was support can become resistance, right? This didn't happen randomly. It's people who bought here, regretted buying it when it went lower, and they decided they were going to sell if they get out of break even. Same thing happened down here.
Right.
People bought here, went lower. This level goes from support to resistance. And why is this level support? Well, because it was an important support level back here.
Yeah, and look, for all the folks here I know you guys have a ton of questions here, but we do have a limited amount of time here. But if you really do want to kind of work with Mark, right, on your trading, on Twitter, just know that on the top, you can just click on that link. That's where you can join the trial. On YouTube, you guys know where you can get that in. But Mark, do you have any closing remarks on the markets and why the folks here should consider the school here before we do wrap this up?
Yeah, because I do have to get on a call at 2:00, so I do need to wrap it up. But I would say this to people. In my opinion, I think the market's going to go lower. I think we're going into recession, and if we're not there already, I mean, we were only one of the few places that I saw that actually thought last quarter's GDP was going to be negative. But anyway, just think about this. Since 1929, there have been 25 bear markets, right? A bear market is a market that goes down by more than 20% off of its peak. So give me a second. I'm just going to shut my door. I hear the landscapers are showing up. All right, sorry about that. So going back to 1929, there have been 25 bear markets. A bear market is defined as it gets to a peak and then it drops by more than 20%. So it's happened 25 times since 1929. The average bear market is down 35% off of its top. All right. So the S&P 500 peaked around 4,800. That was in December, very end of December, very early January, around 4,800. Right now we're around 3,800. For us to get down 20% off, 35% off of the highs, like has been historically the case, we would get down to about 3,100. So that's about 17% lower than where we are now. So if history is any guide, so that would put us right down about here. If history is any guide, and it typically is, there's a good chance that this, sell-off, it might slow down in intensity. It might just become more of a gradual slide. But I think we're still going to go lower. And I would tell people that they should join because they're going to learn how to make money when the market's going lower. And then when we finally get to a bottom and we finally get to that capitulation, we're going to know it. And then we're going to be able to make money when the market is going up. So as traders, we don't want bear markets, but we don't fear them because we can make money off of them. So that being said, Rodrigo, I got to hit the road here. So I guess you're going to stick around for a minute and take questions. And if that's the case, but I got to hit the road. So thanks everyone for coming. Hope everyone has a nice, there is no class tomorrow, by the way. We're going to be back on Tuesday, and our Tuesday class is going to be our class on levels.
Okay. All right. Well, thanks a lot there, Mark, for being here. Big shout out there. Mark Putrino, Chief Educator at the Benzinga Trading School.
All right. Thanks, everyone. Thanks, Rodrigo. Have a nice long weekend.
All right, Mark. I'll see you there. And folks, really quick. So basically at this point, if you have, for those that are watching on YouTube, I'm going to show you guys really quick where to find the recordings. But on Twitter, just know that if you do want to reach out to Mark, you can actually join the school with the trial on that link. It's on the top, and you can access it immediately so that you can actually watch all the recordings and be there for the class that we have, ongoing. It's Monday to Friday, 7 to 9 a.m. Eastern, and then 12 to 1 p.m. And then Fridays, it's only 7 to 9 a.m., everything Eastern time. So thanks a lot there on Twitter. We're going to close the Twitter space here for now, but if you have questions, everything is going to be on the top link. Thanks for being here, folks. And for those that are there on the YouTube side, I'm going to go ahead and show you here a couple of things. We're going to keep this one rolling, this thing rolling here for a bit, because I do want to show you where you can find this stuff. So if you go to my dashboard, you can see that all of the, you can see all the days, all the weeks ahead, right? Like what class you have Monday, Friday, Tuesday, and kind of set your schedule around that, right? Momentum, Friday, you got office hours. Monday is introduction and philosophy. So this is a really great place to start. I really think it's a great place where you guys should kind of look at this stuff. Hey, what's up, friends? Because this is where you can actually see what's going to happen with the upcoming week, right? And you can plan ahead. The other thing you have is the library. Whenever he's live, whenever Mark is during the live sessions, you just click here and it's going to take you right there, right? And at the side here, just notice that every live class has a live chat room, so that you can actually be there with the rest of the members there, throughout the class, asking questions, participating, engaging, being part of the community, all that stuff. And then You see there's about 134 people there online there right now, but video library, really important. As you can see, this looks very clean, right? This is very easy to follow. You have every single chapter name numbered, Q&A sessions. This is the one we were talking about, the investment psychology. So thank you. Thank you for all the developers that work a lot in there. Neil, Sandeep, Vin, Tammy, a lot of people there. So big shout out there. Um, and then the other thing um, is the chat. These are the live trading rooms. So you have a bunch here, right? You have student project plan chat, student chart of the day, right? Where students share the trade ideas, share the education, implement what you actually are learning. You see, that's called teamwork, right? Where everybody works together, helps each other out. You won't see that in too many places. Questions for Mark. If you are unable to attend the live sessions or the live Q&As, we do have a chat room called Questions for Mark that you can actually ask questions like directly with that specific purpose in case that you cannot make it live, or if you just have a question in general, right, about the lessons and such. Master of the obvious, I'm not sure. This is something new. Then you have Mark's trade ideas. This is where you can see a lot of Mark's setups, entries, levels, right? And you can kind of work your way through that and talk with Mark throughout the day. Let's see, general discussions, community support, class materials. These are all the quizzes on class files. So if you go to class files, you can see that all of the chapters have a quiz, and you can pretty much quiz yourself. And that way see what your weaknesses are, where you can improve. If there's a particular skill set that you think that you might need a little touch up on, maybe, right? A little brush up. So you can do that all day, every day there, and kind of talk with Mark about it, right? Keep in mind, you have these chat rooms as resources, right? As resources, so that you don't go out to these other pump and dump chat rooms. Here, everybody in these chat rooms is a paid trading school member, right? So just know that all these people there are on the same boat with you. And then you have Pro, which is included. And in Pro, you can do a whole bunch of stuff. You can chart, scan, you can look up trade ideas, see what's happening today. Let's look at the gainers for today. NLT. Still going. So you can basically find some, like, not just trade ideas, but also if you want to kind of like mess with this scanner, you can set it up for 1 week, 3 months, 1 month, 6 months, a year, and you can find some good trade ideas there for maybe swings, right? It doesn't have to be day trading. And you can filter this by sector. Maybe you want to trade biotechs or healthcare right now, or energy, on either way, on the short or the long side. You can pick gainers and losers there. So let's see whatever's dropping here. See, this dropped 50%. Not sure why, but you can see a lot of, how you can kind of use this with your own strategy. So I want to give a big shout out for you guys being here. If you do have questions, reach out. The link to join is there on the chat. It's basically a 7-day trial for $7. You trade with Mark, you learn with Mark, you go to the live classes, you join the community, right? And then from there, after the 7 days, if you want to pretty much stick around with the community, it's $14.97 for the year, and it's going to stay that way every year. When it renews, it won't change. So thanks a lot, folks, for being here, and we'll see you guys in the school next time we have the class there. Thank you, guys. Bye.